For thousands of years, wealth was measured by weight. If you wanted to protect your purchasing power, you held something heavy, something tangible, something that had to be physically ripped from the earth and poured into a mold. The entire premise of gold as a store of value rests on a single geological fact: it is strictly finite. There is a hard limit to the number of bars stacked in vaults around the world. But that raises an obvious question. If this metal is incredibly rare, and the effort to extract it is massive, why doesn't the global market price reflect that extreme scarcity? The reality is, the daily price ticker you see on the news has very little to do with the actual mining, shipping, or storage of heavy metal. Instead, the valuation is controlled by a completely separate financial market, operating behind closed doors, playing by an entirely different set of rules. Wall Street has successfully and legally disconnected the price of gold from its physical supply. To understand the global valuation of gold, we have to look at exactly how they severed that link. Let's scale this down to something simpler. Imagine you own a single, highly sought-after trading card. There is only one in existence. Now imagine the owner takes that single card, puts it in a safe, and writes a second certificate claiming ownership of it. Then they sell that certificate to someone else, then a third, a fourth, until there are 10 separate people holding official-looking paper, all thinking they own that one specific card. This chart shows what happens to the perceived market dynamics. When buyers look at the available data, they don't see one card. The market calculates a supply of 10 available items floating around. Because the market prices the asset based on the abundance of this paper evidence, the asset's value drops to a fraction of what it should be worth. Why would the price go up if there seems to be plenty of supply? By artificially flooding the market with paper claims, you can successfully suppress the price in a scarce asset without ever having to print a second card. This same mechanic underpins the major Western financial hubs like London and New York, where global prices are actually set. The core tool these hubs use is the paper gold contract. A contract is simply a legal document, a piece of paper representing a claim on a specific amount of gold. When millions of dollars in gold trade hands on a Tuesday afternoon, the metal itself never actually moves. The vast majority of investors are just buying and selling these paper claims, with absolutely no intention of ever taking physical delivery of a heavy bar. Because nobody ever shows up to ask for their gold, these institutions can legally write and sell dramatically more paper claims than there are actual physical pieces of metal sitting in their vaults. The exact ratio is a tightly kept secret. Nobody knows precisely how much paper is floating around compared to the real metal, but estimates confirm the volume of unbacked paper claims dwarfs the physical supply. This means the globally reported price of gold is an artificially suppressed paper price, dictated almost entirely by a counterfeit supply, rather than actual physical scarcity. A market built on selling the exact same item to multiple people relies on one crucial assumption: that the buyers will never coordinate. Consider the ultimate stress test. What if every investor holding a paper contract walked into the vault at the same time and demanded physical delivery? The entire structure would instantly break down. 9 out of 10 people in line would discover that their expensive paper certificate is backed by absolutely nothing. While a coordinated mass redemption of that scale is hypothetical, the vulnerability it exposes is active right now. Ultimately, the modern paper gold market is a multi-billion-dollar illusion of supply, leaving investors holding highly leveraged claims instead of physical assets.